Awesome. So today we're going to talk about pitching and fundraising, and I'm really happy to intro Eric Yulin, entrepreneur, software developer, CEO, investor, mentor, and the resume goes on and on. So Eric, why don't you just briefly introduce yourself and tell us a little about your journey?
Sure. So I've been in the startup space for most of my career. I was employee number one at a startup when I was in university back in the early 90s. And this was during the days of the PCs. And we basically put together computers in a garage, if you will. Started out like that and then cornered the university market in the southeast and the northeast as well. So that was my initial taste of the startup world. We loved it. I did go to a corporate environment for a while to do software development at what today is Verizon. It was called Bell Atlantic back then, but then after a couple of years, decided I wanted to go back into startups and also the agency space. So throughout my career, I've been in either as a founder, as a consultant, or as an employee working with startups or corporate innovation initiatives as well. I did quite a bit of work for GE Innovation and AT&T and some other venture initiatives as well. Currently, I spend my time across four different areas. One is a mentor at accelerators, including Techstars and Mass Challenge. Second is I advise companies directly. And the third, I consult companies, typically later stage companies or enterprises around their innovation initiatives. And then fourth is I angel invest as well, either through a group, including Walnut Ventures, or directly as an investor.
Mm-hmm. Awesome. So let's talk a little bit about the fundamentals and kind of go back to the beginning. Like when do you know if you should even really raise funding in the first place as a startup, as an early stage we're talking here, right? So like pre-revenue.
Yeah, I think there's also the philosophical aspect of fundraising. I think there are too many startups that really have a immediate reaction. We need to raise funds, and without truly understanding why they need to raise funds and what the purpose is. And they see raising, whether it's a pre-seed seed round or a Series A as a goal, as opposed to a method or a technique to grow a company. And the question is, why do you need funding, and at what time do you need funding? If you're in a type of environment or industry where you need to build out and it's basically land grab situation where you need money in order to grow, that's one thing. But I think at the same time that there are plenty of opportunities for companies to bootstrap and try to bootstrap for a while and grow a healthy business before they raise funds and really use funding as an accelerator to grow sales and the company overall. There's some good examples of companies that have bootstrapped and are perfectly happy doing so, or even have gone back to buying out their investors. Wistia is a local company here in Boston. They just recently bought out their equity investors and took on $17 million worth of debt. It's a great story because they're extremely happy having done so and gave their employees more share in terms of the company and the success of the company. So I would suggest any entrepreneur, when they think about fundraising, is figure out why you need to raise funds, how much, and then at what time is the right time to do so. Because once you're on the fundraising train, even starting with angel investors, but then especially with venture capitalists, there's no going back. You're on board and you can't get off at that point. So think about it and think about your strategy.
Mm-hmm. So when you raise money from venture capitalists, does that necessarily mean that your exit is generally always focused on selling the company and exiting or basically selling it off?
Well, the VCs are looking for an exit, right? The question is, what type of exit are you going to have? Most companies get acquired. Roughly, depending on the statistics you look at, 8 or 9 out of 10 companies are acquired if they don't fail, right? And then only if you go public. So that's another aspect of raising funding is as an investor, you're interested, especially early stage investors are interested, what's the potential exit strategy for this company? If I give you my money today, and I'm looking at, let's say, a 7 to 10 year horizon, how much might I make back and how might I make that money back overall? And then are you setting yourself up to either go IPO or be acquired in the future? And scanning the market, finding out who your partners might be, and building the foundation to potentially be acquired in the future, I think is a good strategy as well, to think about early rather than late.
Can we talk a little bit about valuations? Because I've been speaking with quite a few startups, and we're talking about funding quite a few times, and the topic always comes up of like, well, what sort of valuation do you think that you can get? And some of the people that I talk to, they run startups that are post revenue, and they might have $10 or $15 or $20,000 monthly recurring revenue. And I mean, it's just that the numbers are kind of like all over the place. And from what I understand, it's just what the market will give you. But I'd like to ask you, what's the deal with valuations? How does that all work? And how
it is a pretty wide range. The market, the valuations of companies have gone up and up, right? And the question is, when does that increase? And you could argue inflation going to stop or slow down, especially in the Valley. Valuations might be slightly different in different regions of the world, and also within the U.S. Valuations in the Valley are definitely a lot higher than they are in Boston, for instance, or other markets in the U.S. I think the valuation aspect of it is difficult, especially for early stage pre-seed companies, pre-revenue companies. But there are different variety of different methodologies you could employ in order to figure out what your valuation might be. But in the end, it's up to the investors as well to value your company. And you might get different offers for different valuations of your company from different investors. And you have to figure out who, not just from a valuation perspective, but who's the right investor you want to partner up with in the future. Because there's more than money involved. It's also, is it the right investor for you to take a lead and pair up with, let's say, for the next 10 years as well.
No, absolutely. I mean, what sort of networks do they bring to the table? Do they have expertise to share? Like, will they bring advisors on board? It's a lot more than just evaluation, right, in my opinion.
Right.
And in terms of like the types of funding, right? So there's accelerators, there's venture capitalists, angels, crowdsourcing, Kickstarter, for example. For early stage startups, like where should they generally be looking for in the beginning?
Yeah, in the very beginning, it's typically friends and family, right? That you would at least get a few checks from. That's the first stage to at least get you started. Then the next stage, typically you look at angel investors, either individual angel investors or angel groups, such as Walnut Ventures here in Boston. And there's a wide variety of angel groups as well. For instance, the group that I'm part of, we're about 35 members, fairly small, but fairly experienced entrepreneurs as well, who have had successful exits and who understand the entrepreneurial side. There are also some larger angel groups. Again, speaking from the Boston perspective, there's some angel groups here that have 150 members overall, and that typically is the most manageable size where angel groups tend to top off. And then the angel groups also have different investment theses and philosophies, right? So for instance, when you look at a Walnut Ventures type of organization, it's all members driven. The members make their own decisions in terms of where to invest. There are other angel groups that take the lead as well and become lead investors, which is what my group does not do. We typically either pair up with syndicates or invest as individuals as well. After the angel investments, angel investments tend to be in the pre-seed seed stage, although there are more VCs that also have seed stage funds at this point as well. But once you get to the Series A, it's a venture capital VC type of investment at that point. And you also have to think about the difference between VCs and angel investors. Angel investors invest their own money, right? And venture capitalists invest other people's money. So the decision-making process in terms of what's considered for investments and whatnot tends to be very different as well.
And in terms of like getting in contact with angel investors, VCs, and so on, what's the sort of method? Like, you're an investor, right? Like, how would you like to get approached as an investor, and how would you not like it?
Sure. Yeah, the best approach is warm introductions. If you know someone who knows the investor who can vouch for you and make the introduction, that always works best in general. There's some investors that will certainly take cold introductions, and they might be very vocal about that as well, that they will at least take a look at your company. In terms of ways to approach investors, whether it's VCs or angels, some angel groups are very open in terms of their application process. You can apply online, you can submit your deck online, and then you might get into the deal flow, and then they will select you to either pitch, or they might get you into at least take a look at your company. There are other groups that are more closed. You might have to do more homework in terms of how to approach them, or you might approach individuals within that group who can then make that introduction. Email introductions or getting targeting investors by email. Again, it's like any sales process. Fundraising is sales fundamentally. So you might have you've got to qualify investors just as you would qualify customers, and spending time wisely in terms of who you're going after. I see too many entrepreneurs going after investors who are not the right fit very clearly. They might have different industry segments that they invest in. The amounts that they invest may not line up with what the particular founder is looking for, or the stage might not be correct at this point. So you've got to make sure you target the right investors. Again, email is okay. I get a fair amount of cold outreach via LinkedIn. Personally, I'm okay with that. I'll let founders know very quickly whether I'm interested or not, or want to have a further discussion. I'm fine with that. I think there might be some investors who will just ignore it, right? So again, it's like any sales process, you've got to find the right channel, you've got to qualify investors, and you've got to find the right way to get in front of them.
No, makes sense. I mean, just give it a shot, I guess, and so it doesn't really hurt. The worst that can happen is someone's going to send you an angry email, but I mean, it's not the end of the world. And let's say you actually get a qualified investor who's interested, and the next step comes to tell the story, sell it via pitch deck, right? Like it's a major topic which comes up on Growth Mentor many times, like how should I structure my pitch deck? And I even think that maybe you've done a couple of calls on that topic as well. Like what sort of advice do you have to founders about how to really knock that out of the park, like their pitch deck, their storytelling and all that?
Yeah, and I think this is exactly right. It's about storytelling in connecting with the investor on a human level as well, in addition to on a rational level. There are a variety of techniques in order to tell that story about why you're doing this, why it's important, and why now. You really have to focus on that. And if you think through the investor's mindset, early stage investors, you might be in front of 10 different investors. They might have 10 different reasons for wanting to invest in you or not wanting to invest in you, right? But ultimately, it's fundamentally it's about business as well and making money. So you've got to think through, of the things that you need to have that investor take away is, for me as an investor, I need to understand, why am I giving you the money right now? What might my returns be in, let's say, 7 or 10 years? And why am I giving you my money versus the 40 other startups I'm looking at this week? Right. So it's a numbers game as well. Right. So that's ultimately at the end, I've got to be interested to say, I'm interested in business. Let's do the deeper dive or do due diligence. Right. And that doesn't mean I'll write a check in the end or another investor will write a check, but at least you get into the next stage. In terms of the what to talk about, you typically, there's a rule of thumb, let's say you've got a pitch deck, 15 to 20 slides. I think it's a good rule of thumb to follow, but at the same time, it depends on how you're telling your story, right? You may end up with 25 or 30 slides that are highly visual as well. So don't use that as hard rule. More important is to talk about how you are, what the problem is you're solving, how are you solving it, what the market size is and the opportunity, what the team is, and what the potential is of this particular company overall. I like to hear people start off their pitch, not just talking about the team. And then at times I hear founders talk about the team or themselves for 5 minutes, and it drags on and on. I still don't understand what the company does, right? It's better to start off with, Yeah, really a number of different ways you can start off. One is tell me about a use case of the problem you're solving, especially if I'm someone who doesn't necessarily understand your industry or your segment, right? Help me understand a day in the life of the user whose problem you're actually solving and how you're solving that. Another way is give me a big fact, for instance, some big number or thing that I didn't think about before. Help me understand your industry or segment a bit more. And the third way is also a personal story. Why are you doing this? Why you and why now? And typically, or a lot of times, I would say there's some kind of personal story behind a founder trying to solve this particular problem, right? And I think that it's interesting because it makes a human connection with the investor, and for me, to make a human connection with the founder. And then at the same time, that tells me if somebody's really passionate about this and has conviction, that they'll stick with it if times get tough. Right. And usually if there's some kind of human connection or a personal story, as opposed to just, I want to make a lot of money, which is not a good answer, right? Then typically it tells me that people are at this for a good reason, they'll stick with it. Right. And even if they might end up not having or solving it the right way, they might pivot to figuring something else out in the end.
Awesome. Yeah. So the founding team, incredibly important. Don't bore them with the story before you've succinctly explained what the product does and why it matters, and create a human connection and show the investors that you're in it for the long haul. Awesome, love it.
Yeah, and just a few things I think that some pitfalls or things I see go wrong at times. One is you don't get to what it actually is, or don't explain very well what you actually do until far into the presentation. And help me understand this in very simple terms. Expect that the audience or your investors don't understand the industry. And you tend to find this more often than not with technical founders, or those in highly technical industries, such as life sciences, for instance. There's a lot of jargon, a lot of elaborate explanations of what the problem is, what the solution is, when it should be very simple to explain about what you do, how are you solving it, and how you expect to go forward. The other piece is then talk about competition. I think it is sometimes I find founders wanting to hide it or not talk about it directly, right? They're afraid of talking about the competition. I think that is the wrong thing. You should talk about your competition, and usually there is competition, right? And sometimes you do have the slide, well, but we're the only one in this particular space, which in that case, my flags tend to go off because usually there's always somebody in that space competing with you. And there are probably a lot of companies, right? Or they might be tangential, or they might be related to what you do. They might be substitute products. But for you to talk about it is good because it helps me understand that you really truly understand the industry, and then talk about how you're different and how you expect to compete. And talk to me about your weaknesses as well, right? It tells me that you understand your weaknesses and how you plan to address them, or that your strategy is about not addressing them potentially, right? Because you can bear and go based on your strengths and compete in that way.
In terms and throughout that kind of intro on what should be in the pitch deck, I didn't really hear anything about numbers at all, which was kind of surprising, like in terms of revenue or projected total addressable market size, things like that.
Actually, super important. Yeah, I didn't address it yet. So in terms of numbers, yes, help me understand, or help the investor understand the market, right, and the market opportunity. And including the total addressable market, or the market that you can address, right? And that tends to be different. And a mistake that I see on occasion is call the 2% of China problem, right? We've got a huge market. If we just grab 2% of the market, right, we'll be very successful, without doing a truly bottoms-up analysis of what you might be able to achieve with your company. And especially for those companies that are geographically or regionally tied for some reason. You might have a SaaS company, you could have immediate global reach, or you might have a company where you need to think about Uber, for instance, right? Where you are geographically tied and you need to build out geographies and capture those geographies. And you have physical assets that you need to incorporate in your model as well. So this is a very different game than being purely software-based play. But yeah, the market opportunity is very important. And then also think about in terms of total addressable market, think about the true market size of your customers, right? Of what they're wanting to pay. So for instance, you could say, look, we've got a total addressable market of, call it $5 billion of IT spend. Well, but you're providing a SaaS platform for, let's say, HR hiring type of solutions, right? So what is that particular market like? So a lot of times there's a larger market given than there truly is. And as you go about this, also figure out, do a bottoms up analysis to make it more worth it and true. In terms of numbers, extremely important as well, right? Because as you go along the journey, your traction becomes and is extremely important, right? And numbers at that point count.
Yeah.
So you do want to show revenue. Once you get revenue, you do want to show, it's always better to show paying customers, even if you're in a pilot phase. If you can get customers to pay for a pilot, that's really good news, because you know that more than likely there's a problem you're solving and people are wanting to pay for it. And then forecast out 3 to 5 years, right, depending on your business. Early stage, obviously, if you pre-seed, extremely hard to do 5 years, but at least make some reasonable assumptions and hypotheses in terms of how you might get there.
In terms of non-revenue producing traction, like users, like for example, Growth Mentor, the first 6 months, it was like basically free to sign up and very few paid sessions were being called, but there was really high traffic, like, traction, user sign up and so on. How important is that? How do investors view that, like non-revenue producing user acquisition?
It depends on the business model, right? I mean, in this case, your business model is really subscribers, right? So in the end, what's important is that you convert those subscribers to paying users. If you were, let's say, an advertising model, that would be less relevant, right? Because it is about the number of users, daily active users, whatever your model is. But in this case, let's say in your case or with Growth Mentor, it's good to understand from an investor perspective how many users you have, even if they're not paying. But eventually what becomes more important is, are you able to convert those users to paying users, right? And what's the engagement of those users? And especially for Growth Mentor, how many sessions do you have on a monthly or daily or weekly basis, right? Whatever your North Star metric is, becomes extremely important. You'll find if, let's say, in the Growth Mentor model, you might have some investors who are comfortable investing early stage before you have those paying users. Others may say, it looks great, but come back to me once you do convert a certain set of users, and here's my metric, right? Here's what I'm looking for. And what's important, if you have that type of investor who's truly interested, but tells you exactly what they're looking for or directionally what you're looking for, that's a good lead for you in the future, because if you can come back, let's say, and your metric is, let's say, number of paying users or percent conversion within, let's say, 6 months, and you're able to hit that number, that's a good story to tell, because then you can get back to that investor and say, hey, here's the metric, I hit my milestones. Hopefully that person will be interested at that point.
Yeah, awesome. I think that goes to show the value of building relationships even earlier on. If you have in your mindset that, hey, at some point I will raise funding, talk and build a relationship with investors earlier on in your journey, so that then you can go back to them 6, 7, 8, 9, 12 months later and be like, hey, remember me? Look at what we've been doing the last couple of months. And in terms of like getting, go on.
Yeah, no, I would say on that topic, be selective as well, right? Again, it's like I always go back towards it's sales, right, and sales qualification, and I think it's good to build relationships with later stage investors, but at the same time, you only have so much time in the day, right? And you've got to be selective to do that. I would say definitely do that, but again, make sure that you build the right relationships and go after the right investors, and not expect and have the right expectations too, right? Sometimes founders go to Series A type of VCs and think they'll get a check immediately, which is not the case, right? I mean, you've got to set your own expectations as well, and then to set the expectations of those investors.
And in terms of a time commitment when you're actually going over there trying to raise funding, I mean, I've heard from different founders that it's almost like a full-time job, which like for me sounds insane, because we're kind of a small company here. It's like I already have 2 full-time jobs. So
Yeah, it can be, again, depending on the type of business, how much money you're looking to raise and what stage you're at. It can be anywhere from full time to, maybe 75% of your time. That I would say half time, right? Again, it depends on how well connected you are, what type of environment you're in. Let's say if you're in Boston versus, let's say, somewhere where there aren't a lot of investors, right? All that makes a difference. But I think the key point is it is definitely a lot of work, right? And you need to carve that out. And you need to think through your long-term fundraising strategies. When will you raise funding? Once you close funding, then you can start focusing very heavily again on execution operations. But there comes a time when you need to raise funds again. So how much time do you have and give yourself, right? So then that leads back to how much money you're raising and what will you do with that money. What you probably do not want to do is raise enough money, just enough money to give yourself a few months, and you have to raise again, right? And, typically, you want to give yourself 12 to 18 months of runway, and then raise the next round at that point, or have the money in the hopper at that point, whether it's 12 or 18 months.
Awesome, Eric. I think that we've reached like the kind of end point of the podcast. So if you have any other sort of advice or tips to any startup founders that are in this whole like fundraising mindset, feel free.
Okay. Yeah, no, I would say again, in general, just how I start off as well. It's very important to think about why you're raising funding and how much you need to raise and what you're going to use that money for. So think through that. Think through the strategy. There's nothing. I think it's actually good if you can bootstrap for a little bit and then build a healthy foundation. If you're early stage, and if you are able to build a healthy business and one that then you can show a lot of traction, investors tend to come to you, right? As opposed to you having to seek out investors. So that's a nice position to be in when you're the shining object that people want. So think about that as well and make time for it and make sure that your team, and that includes your co-founders, if you have co-founders, are bought into that as well.
Mm-hmm. Awesome. Thank you so much for your time, Eric. And if anybody wants to talk to you about investments or, maybe some feedback on their pitch deck, we're going to contact you.
Yeah, obviously via Growth Mentor, best way to reach out to me. And otherwise, I'm available via other channels as well, Twitter, LinkedIn. And tending more of a LinkedIn user than Twitter. So don't expect too many tweets from me.
Awesome. Thanks so much for having me on, Eric.
All right. You're welcome. Bye.
Bye.